Welcome to the Second Bite Podcast, where we talk with top entrepreneurs and CEOs about creating valuable companies through creative transactions. Now, let's get started with the show.
Welcome to the Second Bite Podcast. We're doing the Founders Question Series, and this is the fourth and final of this series. How do you know the time is right? This is always a struggle for entrepreneurs because next year is going to be better than this year. The year after will be better than that. I'm going to be more valuable in the future. Why would I sell now versus selling in the future? It's not for me to say, but it's very helpful to hear other founders and how they've thought about that before they've gone into their transactions. So I think you'll really enjoy this episode. Thanks to our sponsors at Fiscal Advocate. They create a tremendous dashboard for agency founders to really measure and understand their business as it relates to other agencies in the industry. And it's just a really helpful tool. So thanks to the folks at Fiscal Advocate, and enjoyed this episode. So, John, how do you know when the time is right to do a transaction? Because most entrepreneurs, next year is going to be better, and the year after will be better, and the year after will be better. And you can always convince yourself of that. How did you know it was the right time for you guys to do a transaction?
So it's a great question, and you're right. And by the way, Rise has done better every single year since I have left. So for me, there were a few different things that were at play. So the first thing was, my original exit strategy was I was going to die one day. And I never wanted to sell. But then I got married, I had a family, and all of a sudden I had this asset with tremendous wealth built into that asset that was illiquid. And diversification became a really important component for me that I took a lot more seriously than I took before. So that's one thing. The second thing is every year, my favorite day of the business day of the year is the first business day of the year, and I call it game day. And I spend several months always preparing for game day and for the next year. And in October of 2019, I finalized my plan for the next year, and it just didn't feel very different than 2019. And so as I was preparing for 2020 and I went into it, I was like, you know what? I'm just not excited about the level of complexity, the unique things that I was going to do. Like, it just didn't feel different enough. And it was the first time ever where I was like, you know what? I think I'm ready to do something different. And so after 16 years, I decided that I just was ready for a different challenge.
Excellent. That's great insight. John Morris from Fiscal Advocate, thank you so much for being on with me. Question number 4 for Matt Sunshine. Matt, how do you know when the time is right? And I know that there was dynamics because there's 2 partners, that you have a partner, but next year is going to be better and the year after is going to be better. Well, how do you know I'll do it now as opposed to waiting one more year, which is I think always the question.
Yeah. Well, it's like, when's the best time to plant a tree? 20 years ago. When's the second best time? Today, right? I think that, my vision of the company, this is a 40-year-old company, and my vision for this company is that it'll celebrate its 100th anniversary. So that means I have to set it up for success, because I'm not going to be here when it celebrates its 100th anniversary, right? Someone else is going to be leading this company 60 years from today. So my obligation is not just to pull out whatever I can today and operate it for today. My obligation is to set this company up for long-term success. In order to do that, we need to grow the company. And in order to grow the company, I realized I needed to pull in a private equity partner to help me make smart acquisitions and continue to grow this and set it up for that long-term success. So yeah, could I have waited? Yeah, I coulda, I guess, but at some point you got to pull the trigger.
And is there any difference then between this year or the year you did it? And if I just wait one more year and our EBIT is 15% higher, I'll take out a little bit more cash. Well, what is there? Were you tempted by that?
Sure. I think that I think that anyone that says they wouldn't, that's not a consideration point, isn't being truthful, right? They always have to look at that. But there's a lot of unknowns, right? I mean, interest rates go up, and or a key one of your best customers goes away, right? I mean, it's easy to think of, well, next year's going to grow at the same rate as this, but what if the market changes in the worse? Or, I mean, you don't know what's going to happen. So you look at what's going on right now, you make the best decisions you can with the best available information. And again, my vision was more of a long-term vision. I did want that second bite. I wasn't going anywhere. I didn't want to sell and leave. I wanted to sell and grow. And I think when you have a sell and grow, when it's an evolution, not just an exit, your words, but I love those. When it's an evolution and not just an exit, maybe you approach it a little bit differently. Maybe if all you're looking to do is exit, well, then maybe you're looking for the best cash deal that you can possibly get. But when you're looking to evolve the company and grow it significantly, you have a longer horizon.
Yeah, and you found a great partner in the guys at Gemini. So congratulations on that. And thanks for the insight. So, Mike, I know you put a lot of thought into your transaction, but the question and the feedback I hear a lot from guys considering a transaction is, next year's going to be better, and then the year after that's going to be better. And as an entrepreneur, I think the glass is always half full. How did you guys, because there was 4 owners in your business, how did you come to a conclusion or a determination that now is the right time versus waiting another year or another year?
Right. It's a multi-factor decision. There's a lot that goes into it. You certainly want to understand where your shareholders, your owners, your partners are at, what they're thinking, and time wise related to any exit strategy. But you also have to look at your employees and your customers and the market. So you generally, some of the key factors for us was, when is the market good, right? In terms of multiples, in terms of activity, M&A activity, because you want to go into a market that is a hot market. That's going to drive your valuation to a large extent. You can have the same results in one market versus another. And I think right now, probably compared to a few years ago, multiples are half of what they were. So just speaking like right now, for anybody, it's probably better to wait another year, 2 or 3 for the M&A market to pick up. So it really comes down to your a gut feeling of when is the right time, taking into account all these factors. You also have to look at your opportunity cost, right? You say, if you can, you want to go through a process now and exit, then you may have a 1-2 year transition phase, and then what are you going to do after that? Versus, and what's the return on that going to be versus sticking it out? If you're growing 20, 30+%, then you're not going to get that in the public markets, right?
Yeah.
Or even in other investment opportunities that you have to take that cash and put it into another vehicle. So you need to look at it in an ROI perspective as just another factor.
Mike, great feedback. Thank you.
You bet.
Your business in your agency was always growing. And I presume when you did your transaction, it was going to grow next year and the year after and the year after. So what happens in your mind, and how did it go for you when you decided, now might be the right time to do a transaction?
It's a funny question. And I think if you ask 4 different people, you're 100% going to get 4 different answers on this, which is why it makes it a really interesting question. My exits were opportunistic. A phone call came in, and it was interesting enough to have a conversation. One of my larger exits, my partner and I invested in the business, became a partner, and we always had a point of view that we would exit at one point. But as we were growing the agency 50% year over year, or more, and one year was 100% year over year, we kept on moving the goalposts and to ourselves saying, well, it's going well, we should do this. It's going well, we should do this. And honestly, there's that saying that, there's a price for everything. And if an offer comes in that stops you in your tracks, that's often what happens. It stops you in your tracks.
And was that offer, when you considered that offer, I know the economics was very important, but was the strategic nature of the fit and what could allow you to do, was that also important?
It was the entire bookends here. Who was buying it, when they were buying it, why they were buying it, the capabilities. For us, in particular, it vastly accelerated what we could do on a platform level. We were a Sitecore shop; they were an Adobe shop. It gave us a national footprint that was important to us. So it opened up a lot of possibilities. I remember I had this one woman who worked for me, and we were at an all hands meeting once, and we were talking about the growth of the company. And I said to her, when you got here, what were you working on? And she mentioned some law firm she was working on, website for us she was working on. And I said, and what are you working on now? She says, well, now I'm working on Comcast. And her career level, sitting in the same desk for 5 years, was amazing. We wanted the same thing to happen. And part of the reason we did the acquisition was to provide that for us and the staff as well.
That's super. Lance, thank you for sharing.
My pleasure.
So, Aaron, one question that comes up is, what's the right time? Because every entrepreneur next year is going to be better than this year. And so why don't I just wait another year? Your perspective, I think, is a little bit unique because of the private equity relationship you've had. What would your insights or observations be around that?
Yeah, I think that you have to think about, and you're not wrong, everyone, if you are running a business, hopefully you believe that next year is going to be better than this year. What you have to factor in is, against the competition, do you have the capital, the resources, and the brain power to compete and take it to that next level fast enough and not miss out on an opportunity? And so are there more well-funded or well-resourced or well-advised companies out there that are competing with you while you don't have access to those things? They might be able to skyrocket ahead of you if you don't do that. And for example, with being PE backed, we were able to do a big collaboration around AI with a management consulting and engineering firm that's like top of their game in terms of AI. They've done hundreds of projects, and it's an expensive investment that we wouldn't have made if we were bootstrapped. And now we're that much further ahead of the competition. You got to think about, like, if I'm sitting here with the PE money and the roadmap and the funds, what kinds of things am I investing in that if you don't have that kind of background or resources that you might not be tapping into as kind of an entrepreneur?
Yeah, that's great advice, because I think many entrepreneurs tend to look at their business introspectively without a broader picture of the competitive forces that are going on in the market and, what competitors are partnering up with private equity, acquiring other businesses, becoming larger, and so on. So that's great advice. Aaron Sigich from Perform CV, always appreciate your insights. Thank you so much for sharing.
Thank you.
So, Peter, the question I hear a lot, how do you know the right time to do a transaction? And particularly in your business, you were growing year after year after year. So why not wait another year or another year when, in theory, the company would be more valuable still? How did you process through that?
It's really don't know the answer to that question. And hindsight's always 20/20. In our case, obviously, if I waited, I would have made more money. But my investment banker, and I think he was right, the advisor that I had, kept saying to me year after year after year, one down year, you're going to have to wait for 2 up years. And so we basically came up with a dollar figure in my mind that was like, once I'm over this dollar figure, even on the first tranche, I'm going to be financially free, financially, where I want to be. And so everything becomes, upside from there. And I think there just becomes a time where it's important to take chips off the table. I also think for me, the driving factor was that my key people were very excited about being able to get stock options and start to participate in, an additional sort of level of ownership in the company. And so it was going to be good for them. So I think that I hit a number where it was good for me. We hit a number where we hit a place where the key people were excited about getting stock options, and we had a lot of interest from the market. And so I don't think you're ever going to know the answer to that. And if you wait too long, you may miss out. And if you go early, as long as you can be happy with it, I don't see how it can be a bad time. So I think it's a very personal question, but and I think anyone's going to wrestle with it. I know I did.
In hindsight, again, it's great perspective because you're 4 years past your transaction, and I guess in theory, if you waited longer, you would have gotten more because the company was successful. But who knows how successful you would have been or how much your new partner contributed to that. Do you look back now with any regret about the timing?
You can't look back and have regret. There's just you can only go forward, right? So it's just sort of a waste of time. I mean, look, you could argue it either way. We grew quite a bit after the transaction, and we might have even been able to do a recap a little bit sooner, but then the market came down. So there's both internal factors and external factors. The fact that the interest rates are higher now, puts a little pressure. Maybe deals aren't going to happen now, at least for recap for a year or two. So you never know what's going to happen. If we had a bad year, that could have put us 2 years out. If the market fell apart and it was a bad time to put deals together, if COVID had hit, if we had waited any longer, COVID would have hit. Maybe we wouldn't have got a deal done. And maybe it was going to be better. Maybe it was going to be worse. Nobody really knew. So I think that once you get to the point where you feel really, really comfortable, you have to view it as sort of the next step in the evolution of where you're going, and not beat yourself up over it. Yeah, we would have made a lot more money if we waited a year, but I can't look at it that way.
Peter Stavisky from BMG 360, thank you so much for sharing your perspective. Very valuable and appreciated.
Thanks, Todd.
Lindsay Frey from Demand Drive, you and Dan had a great transaction a couple years ago now. Mm-hmm. The question I want to ask you, you had grown the couple years before. Mm-hmm. You were going to grow that year, mm-hmm. and then the next year and the next year and the next year. So why not just wait? Next year, you're going to be more valuable. Your sales will be better. Your EBITDA will be better. Why'd you do the transaction when you did, as opposed to waiting till you're quote unquote more valuable?
Yeah. So I think that was probably the biggest question. I think that was the biggest question that I personally had, because we were growing really well, as you know, right? You helped us with this. So, we had seen really good growth year over year, and Dan and I were able to, do well for ourselves. And I think the question always became like, hey, could we just keep doing this? If we just wait another 12 months. But I mean, you and I were joking around earlier, unless you have a crystal ball, you don't know what's going to happen. So to me, I was like, there was some certainty in taking some chips off the table, right? And kind of, I don't know, for lack of a better term, like cashing in on some of the work that we had done and what we had built for a decade. But I think the really unique piece and structure of our deal is that we rolled so much equity. I mean, Dan and I retained almost 50% of the company. And to me, that was so crucial because it felt like still ours, like, hey, we still own 50% of this at the end of the day. So we have so much buy-in. And so that really kind of helped, because I knew we still had so much upside. We still had so much equity. We were still marching towards kind of the same goals, but it allowed us to again, cash in on some of the hard work that
Right.
we had put into this. And I think the other big piece was just bringing in a partner, bringing in someone that had navigated the, mergers and acquisitions. Dan and I do not have a background in that. We would not have been able to pull off 2 acquisitions in the last 2 years without having done this. So it has allowed us to grow. We could have kept going, right? And then you hit a tough part in the market, and you don't know what's going to happen. And there's just something nice about having a partner in this and being able to also grow by acquisition, not just organically.
Yeah, it's interesting because one of the acquisitions you did was Digital Impulse.
Right.
And Andrew Kalidas was on the podcast. For those listening, it's a great episode to listen into. But he said specifically, this was about me executing my plans for growth.
Mm-hmm.
And the way he viewed it, they bring a lot of web dev to your offering.
Yep.
The way he views it is, we're a web dev shop, and now we brought all this capability into my company.
Right.
I just own a much smaller piece of my company, but it's still mine. And so
it's a great way to look at it. Yeah.
Yeah. And so that's the way that he viewed that. It's interesting to hear you view it similarly. Mm-hmm. Great insights, Lindsay Frey from Demand Drive. Thank you.
Thank you, Todd. It was great chatting with you.
Andrew Kalidas from Digital Impulse. You talked about in your podcast episode, which people should listen to, that this was, in your mind, the next step in your acceleration plan for growth. Mm-hmm. But my specific question is, next year, you had been growing the years before and were anticipating to grow the year we did the deal and the next year and the next year.
Yeah.
Why not just wait another year or another year when the company will be more valuable and worth more and a better transaction and all those things that we tell ourselves? How did you manage that whole thought process?
I think it's a really good question. And that's sort of the age-old question of when, right? And there's a couple of different elements that you think about. One is just growth in general. When you're growing on your own and you have a really nice growth path, you know how fast you can go. We were all self-financed as well. So when you think about just finances in general, when you are all self-funded, no debt, totally clean, we wanted to keep it that way. In services, your people are your product. Your people and your process are your product at the end of the day. So to grow, you have to keep adding more and more people. You have to keep building onto the process. It can get expensive. And in any services industry, things happen. Clients maybe discontinue service. Maybe they're not doing well as a company. Nobody wants their products or services. Market conditions can change. So then if you're all self-funded at the end of the day, that poses a lot of risk, personal risk, and risk to your staff. So even though we were doing well, it's just nerve-wracking when you're dealing with much bigger numbers. So what happens is somebody who's a natural risk taker starts taking less risk. And you start going away from the principles that actually helped you build the company, which is being aggressive, going for growth, because you have your own family, you have your own mortgage, and you think about all risk in terms of how could that affect my family if I make the wrong decision. And that's just the wrong way to be as an entrepreneur. So getting a deal done, now you have financial backing, you have people who could give you expert advice, you have new clients and to sell to through other partnerships and other platform companies. So it actually becomes something that can actually heavily accelerate your growth.
That's a really interesting observation. Did you notice that was seeping in more and more to your decision making, your risk tolerance?
Yeah, I think absolutely, being totally transparent, because you also have partners, right? So you don't always share the same risk tolerance. So a couple of kids in school, 3 partners that have families as well. Every decision you make, you're actually making them take risk in addition to yourself taking risk. So decisions, I don't mind failing. I have a total growth mindset. I always have. If you fail, you've learned something, you pivot, you go in a different direction. But I didn't want any failings that I would have to affect other people around me. especially in that type of way. And honestly, now I feel like I could be a lot more aggressive in my decision making again. It feels more exciting to be in business. Instead of just managing a business, I feel like I'm growing a business again the way I need to. So that was some of the thought process. And it was that feeling of being liberated. You definitely take something off the table, which also helps give some personal security, which takes some additional worry off the table that is also, part of any transaction. But that wasn't the main reason. I just wanted to do something bigger and better. And eventually, you're just moving much larger sums of money in a service business. And without that financial partner, it's difficult to keep aggressive growth going without assuming just a critical amount of risk that I would say most people would be uncomfortable with at some point.
Andrew, that's great insight. Thank you for sharing.
Yeah, absolutely.
Kevin, one of the questions that I get a lot, and I wonder, you guys were growing nicely year after year. So why not wait another year? Next year, you'll be a little bit bigger. You'll be, in theory, you'll be a little bit more valuable. How did the three of you think about, getting the timing right for doing a transaction?
Yeah, I don't know if you can ever get the timing perfectly down, but I think for us, we were starting to reach an inflection point where we had grown the business quite substantially and quite successfully, which was fantastic. But we were starting to get to the size of, if we were going to continue to do this, we're going to have to start adding some serious overhead about, having a full sales and business development function, having a true HR function, having a true finance function, versus it all being a part of the partnerships, that responsibility. And for us, we were just looking at it as like, all right, we're at this inflection point of, we can go down that path and do that. And we explored both cases of like, okay, here's what it would take and here's what we'd have to do to that next level. And with that, adds more cost and more risk. Or it's like, we can find a partner that will help us scale and make us evolve that much faster. And that's ultimately the route that we chose. I think the other thing that we focused on is, as you grow, your client demands want more and more different things. And it was like, we'd rather focus on being what we're really good at, and then lean on our parent company or the new company Power to really be able to help on those other areas. Versus when we were smaller, it was kind of like we would have to lean on a lot of generalists. And I think that's, as the business matures, that becomes more and more challenging to do.
And 18 months later, you get a fairly decent view. Do you have any regrets about the timing that you did the transaction?
I don't think that, I wouldn't say there's regrets in terms of the timing. I think overall it's been successful. And I think, to me, the more important piece with timing is finding that right partner and really align. So from that standpoint, we feel really, really good about what we were able to do and what we were able to achieve working with Power. And we really do like the relationship there. So I would say that's probably the most important thing. Like, don't rush it into a partner that doesn't feel right, and really make sure you feel good about who you're partnering with.
Kevin Biondi from Sproutwork, thanks for sharing your insights.
Thanks for listening to the Second Bite podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.